Okay, good morning, everyone. Um, Welcome to another presentation and update on the global outlook. Never a dull day. We've had some really interesting, challenging times, and I think we're assured of it for another 4 years under Mr. Trump, hence the title, A Trumpian World. What's the outlook going to be like for 2025? So I thought to begin with, let me just start with a recap of how markets performed last year. I've got two of these periodic table type charts. The first one there on your screen, hopefully you can see this, is looking at a summary of the major stock market indices year by year going back to 2013. So you've got a really representative view here, certainly pre and post COVID. If you look at 2024, this column, let me just get my highlight pen. And here we go. So if you look at 2024, honestly, you'd be forgiven if you just put your money in at the start of the year in pretty much any one of these indices and went away on holiday for the whole year. You'd have come back and thought, "Oh, lovely! It's been another fabulous year. Let's do it again. Can we do it again?" But what's interesting, and I think what sets the scene, is how things fluctuated between the last two quarters of last year. Q3 was a very rosy environment because that was essentially risk on. If you recall, we had lots and lots of talk about endless rate cuts. In fact, the rate cut talk just got ahead of itself. It was at one stage impossible to keep count of how many times people thought the Fed would cut. And as a result, when that happens, people feel good, sentiment rises, and suddenly people start deploying assets, their monies into more risky assets. And that's kind of what this chart is showing here on the far right, this one. Q3, you had all the usual suspects that tend to do well in a risk-on environment, doing very well. This is just for the quarter. So MSCI Japan, excluding Asia, up nearly 11%. MSCI emerging markets up nearly 9%, and so on. Then comes Q4, and this is when the election campaign rallies and all the talk, the debating, Biden drops out, Harris comes in, etc., etc. And suddenly you've got volatility coming into the system. And before you know it, all the rate cut talk stops. And now we're actually looking at reversals. Will the Fed hike? What will happen to inflation? What will happen to bond yields? And so things start to turn. If you look at the same charts, the same periodic table, but this time by a range of different asset classes and styles, 2024, fabulous year for growth. Really good year. I mean, up 26%. And a lot of that's driven by technology. Technology and growth are largely synonymous. But if you look at the breakdown, Q3, when you had endless rate cut talk, all the suspects, the usual suspects, did really well. REITs, desperately in need of lower rates to boost their sector. That had a fantastic quarter, up 16%, just in Q3. Value did the opposite to growth. There's growth down here, 3.5%. Value up nearly 10. So exactly the way you would expect it to be. Then comes Q4, everything I said earlier, the Trump talk, the elections, etc., and it all reverses. Now, really, what's going to dominate? I think those two quarters now will dominate and set the scene for much of this year. And it's all about tariffs. And we've got really essentially the whole of Q1 to see how this plays out. So it's going to drag on. It's really going to drag on. And the problem with tariffs is that it scares people in terms of what will be the impact on inflation and what will be the impact on growth. It also feeds into this realignment, this reshaping of geopolitics, because tariffs are a weapon. It's as simple as that. They are a weapon. It's probably it's really the best form of economic weaponry you can have out there. And Trump is a huge fan of it as a weapon. He stated that. He made that clear in his inaugural speech. And where we are is that Mexico and Canada are on notice that they're going to be facing 25% tariffs. However, they've been given a month's reprieve. So they've got to go away and come back with some proposals as to how they're going to deal with it. We've seen already in the case of China that tariffs of 10% are going to be, well, have actually been applied. And China has retaliated as well with very targeted measures. It's a straight tit for tat. Bear in mind that China already, from the last presidency of Trump, already had something like 15% imposed on them. So, add the two, that takes it up. In terms of the impact on America, this is the biggest. This is going to affect the likes of Mexico, 78%. 78% of imports in terms of delivery trucks. Now, it's estimated that this is going to add something like $3,000 to the cost of an incoming car if it's the full 25%. And then you've got a smaller portion coming from Canada. As you go down this list, it starts to decrease in terms of the component from Mexico. But the Canadian portion starts to go up, crude petroleum. And to give you a better illustration of how that's spread, it's actually not surprising that northern states in the United States tend to rely more for their imports from Canada. And you can see the percentages here. As you start to move to the east and the west, it's more China. And then not surprisingly, as you start to go down to the south towards the Mexican border, it's Mexico. So this is the impact it has. Look at Texas, 40% of its imports come in from Mexico. That's right on the border. This is where the whole immigration problem is. It's not exclusively in Texas, but it's heavily concentrated there. So what's going on here? And I think that headline says it all. Trump wants to change one simple thing. To him, what lies at the problem, at the heart of it all, the imbalance, is the fact that US consumes far more than it produces. So it's doing the rest of the world a favor. This is, from his perspective. Meanwhile, China produces far more than it consumes. And he wants to rejig this. The roots of this has been going on for some time now. It goes back to the Bill Clinton era and the whole agreement around the WTO. It's the reason why we enjoyed low inflation for so many years. Things are starting to change now. But just look at these figures here. If you take a look at the share of global manufacturing value added, the US is actually, in terms of production, quite low. In terms of consumption, it's huge. It's got really the biggest appetite out there. And it feeds, in a way, it feeds the rest of the world. China's the inverse. Its consumption is right down here, but its manufacturing is right up there. So you've got this cross-like formation, and then you've got the blocks here, just to illustrate the point, just sort of splitting it out. Europe pretty much even across the board, 13, 13, 14. And then, similar sort of picture, give or take a percentage or two for the others. But this is what Trump wants to change. Now, what is it that he's trying to do here? Because if he's trying to just raise money, I don't think that's really going to solve anything. And I don't think that's his reason. He's presenting headaches for the WTO because the two biggest contributors to the WTO are the United States and China. Between them, they account for a massive chunk. It's 20% of the WTO's budget. So they can't live without these two. So they'll be watching very carefully how this all plays out. So let's look at the first thing. This is the thing that really is concerning people. What impact is this going to have on inflation? Well, thankfully, we've got some past precedent here. If you go back to Trump's first term, as highlighted there in the gold yellow box, These two lines show the impact of the tariffs on both headline inflation and PCE price inflation and core PCE. Now, the PCE is the Fed's preferred rate. In their eyes, that comes the closest to the impact on households. Some call it a services inflation. Technically, it's not a services inflation. You would have to adjust PCE a little bit more to get to proper services. Core inflation is simply the headline rate minus food and inflation. So that's also a quasi measure of services, but it's not as pure as PCE. Regardless, whichever one you look at, initially they went up because of the tariff hikes, but then they started coming down. And there's the Fed target, which I think has always been, like a lot of other central banks, by the way, has always been unrealistic. I don't think they've ever fully taken into account the new environment we've been in post-COVID, and then especially post-Ukraine 2022. If you dig down a little bit deeper into inflation and just look at the durable goods component, well, durable goods is essentially anything, any item that lasts 3 years or longer. That's the sort of broad definition. It will include things like white goods, so washing machines, dishwashers, etc., etc. Same thing, same pattern. It went up initially, but then it started coming down. So the rise in inflation, including this chart as well, wasn't due to tariffs. Subsequently, it was already on the rise. This is the whole point. It was already on the rise. And that was because of the COVID supply side crunch, and then accentuated by the Ukraine war. It was those two factors that caused it. But we have a clear demonstration there that inflation itself didn't really do much. And then it started correcting itself. So what could be the reason for this? Well, I think you're looking there at one reason. This is the dollar trade weighted index. And if you look at the first term when Trump was in office, the dollar went up. Then comes COVID, and it starts to crash. Then it starts to rise again. Also, along the way, since then, it has been going up. Look at this chart, which breaks down that trade-weighted dollar index into its two other components, as measured against advanced economies, which is the dark blue line, and the emerging markets, which is that purple line. It's the same pattern. So I had a look yesterday, actually, at what the dollar has done. It hit a low roughly at the end of September. It's actually the 24th of September. And then it hit a peak. It rose 10% until about a week ago. And then it's given some back as markets also have gone up a little bit. And I think this is one of the things that people tend to forget, or at least overlook. And I'm actually really surprised that this is not being talked about more, is that the full effect of tariffs is negated to some extent, sometimes even entirely, by the amount to which your currency appreciates. And in the case of the dollar, give or take, it's gone up about 10% in all the time that the election campaign started to Trump being sworn into office, and now the negotiations around tariffs themselves. Those negotiations have created some volatility. So for every 1% increase in the currency, you've got an effective mitigation of 1% on your tariffs. So for the US, that's had a big impact. And I think this could go some way to explaining this and this during that first set of tariff period. There's the second factor here, because people are saying, well, what about the impact on growth? Well, there's the blue chip consensus. Honestly, I trust consensus data about as far as I can throw them. I mean, the one I tend to follow, because they tend to be forward looking, and generally have a good track record is the Atlanta Fed. And they were already higher before. I remember writing in my weekly towards the end of last year that I thought the growth for the US this year would be closer to 3%. The consensus was down here somewhere. The best I saw at the time was 2.5, 2.5, 2.6, but otherwise it was down here. Atlanta Fed has already upped its forecast to just shy of 4% year on year for Q1 2025. So there's no indication in their eyes, taking into account the possible different tariffs, that growth is going to be impacted. So what about the monies that Trump is going to collect from the tariffs? Well, again, let's go back to history, first term in office. He implemented the tariffs here, and what you saw was a rise from about there to about here. Actually, it's a little bit higher. So essentially a doubling. Even if he does the same this year, or during the course of this term, we're not talking heaps of money. So it also begs the question again, why is he doing this? Is he trying to make America rich? Well, if you look at his tax programs, they're essentially focused around two things. Lowering corporation tax from, I think it's about 21% or something like that, to 15% to boost domestic production. The cost of that actually is not huge. I remember looking at it. It runs into tens of billions. It's not massive. He probably could fund that alone, just on by itself, from the proposed tax tariffs this time round, even if he doesn't get the full 25%. But the other thing he wants to do is to extend the job and tax cuts. Now that's massive, because that comes up for renewal this year. It's a 10-year program. It costs about $2 trillion over 10 years, so 200 billion a year. Add to that the corporation tax cuts, and all in all, you're looking at around maybe 240, 250 billion a year. So you can see the tariff hikes are not going to provide the pennies to pay for it. So this is not about trying to pay for tax cuts. He's got Elon Musk and Doge to do that, the Department of Government Efficiency. And I'm trying to look into the various ways in which they can go about doing this. And there are so many of them. There are so many areas and ways in which they can cut billions in spending. The US spends something like 7 trillion a year. There's scope to easily reduce that by, massively between 15 and 20%, quite easily. Healthcare is huge. That's probably arguably the single biggest one of the lot. So what impact has that had on tariffs? Well, from when he implemented them, which was round about here, they then went up. It had actually pretty sort of negligible impact on markets. But then they started coming down because the usual fear mongering then crept in. And that's what we're seeing, or possibly seeing the beginnings of now. The other factor is going to be inflation, and markets yesterday were rocked by the consumer inflation numbers that came out in America. And the headlines have suddenly done a U-turn. And now it's like, inflation is on the rise again. I mean, I think that was always a given. I mean, there was no real doubt about that. The issues that they're facing, and by the way, if you look at why inflation went up by more than expected, I think it was a full jump of something like 0.5% month on month. It was big. It came down to largely two components, and the biggest was energy. And that's because we've had a recent rise in energy costs. Since then, they've come back. Looking at energy, it's now at around $71, $72 per barrel of oil. That's taking WTI. Brent is a little bit higher. Now, the Americans import Brent quality oil from Canada. So on that earlier chart, when I showed the energy imports from Canada, this is the thing that the Canadians now have to work out. What can they do in terms of that? Do they match Trump 25% tax hikes on their exports, which the Americans will feel? or do they offer some concession? But inflation is the single biggest issue because Trump's whole campaign was based on a pledge to bring down prices. That's the number one priority for American consumers, American voters. It's at the top of their list. And the way he wants to do it is by flooding the market with oil. He wants he wants the shale producers to start ramping up. He's already cleared the way for Alaskan producers to start pumping more oil and other parts in the Permian oil fields. The impact of all of that is that consumers will feel it at the pumps, the petrol pumps. When they next go and fill up their big gas guzzling cars, they're going to notice lower bills. Now, he can do that. This is the reason why he's also pressuring Saudi Arabia to lower prices through higher production. There's one school of thought that this whole comment around Gaza was to get Saudi Arabia around the table to talk and talk a deal. So this is where it lies for him. Housing has stabilized, but there are other areas, household goods, that are impacting inflation. And this is a concern. If you look at the state of the world economy overall, it's actually not bad at all. It's looking pretty good. So when you take real spending growth, these bars are high. The country that's suffering the most is Australia. And I say suffering, I mean, they're having a harder time of it. And that's largely because they're feeling the impacts of higher mortgage rates. So if you actually come to this bar here, the debt service ratio, you'll notice it's got an asterisk there because what they do is they invert the curves. And there are three countries that are low on the bars: Canada, the UK, and Australia. And that's because their mortgage market today is much more short term. It's much more skewed towards the variable rate market. The other three, are all long term. I mean, the likes of Germany, your mortgage is fixed for life. In the US, even though there has been a higher share towards the variable rate, it's still small. It's still small. The majority of people are on 15 and 30-year mortgages. And Japan, pretty much. I mean, we know Japanese rates, they're fixed for some time and have been at ridiculously low rates, and they're enjoying higher real wage growth, which is the problem, which is really a problem that Japan now faces. If you look at some of these real income growth, it's impressive. I mean, these are high numbers. So there's no indication here amongst them that the consumers are looking weak. Generally speaking, based on these metrics, consumer health indicators are looking strong. What are markets showing in terms of risk premium? Well, if you split it in terms of equity risk premium and bond yields, well, equity risk premium throughout this entire time has been coming down. These numbers are low. Remember, equity risk premium is saying how much do investors want over and above the market in order to compensate them for perceived risk. Well, this is saying the perceived risk is coming down. Now, could it just be complacency? Could it be that they've had so much of a good thing they think it's just going to run on and on for some considerable period of time? I don't think so. I mean, I think when you look at this, when you look at the observations around tariffs, which I don't think have fully sunk in yet, I don't think there's any reason to be concerned just yet. The picture to watch is on the right-hand side, is bond yields. Now, overall, what's happened here in terms of bond yields, and if you look at this portion here, just across certain countries, they've been coming down. And it's questionable to what extent they will carry on coming down. I think this will now start to change. And I think it will change when markets suddenly realize that inflation is not going to go away they thought it would. We haven't got a hope in hell of getting to the 2% permanent target. And when that happens, bond yields will start to go up. Some of these yields around high yield and investment grade have come down by absurd amounts. The 30-year has come down even more. These are aspects that don't make sense. And US high yield, this is a mystery. This is a mystery. And I think this is the one that the Fed is watching very, very closely. Um, I said some time back in one of my presentations and also in my weekly that I think the real reason that has driven the Fed rate cuts that we've seen starting last year, and if you remember, they began, I think it was September with a 50 basis point cut. In total, they've done a 1% cut so far. The argument that I put forward was that there's no way in the context of growth and the employment market and everything else that the economy justified a rate cut. The reason I believe they were doing it is because this year and next year, there's a whole load of corporate debt that is maturing. And that has to be rolled over. And if it gets rolled over at the then current market rates, it would sink a whole load of companies because the interest costs would be so massive, it would shoot up to such an extent that it would give them profitability issues. I think the rate cuts that we've seen, and we probably got another 125 basis point cut left, possibly two. But the Fed's not in any hurry. I mean, they said so yesterday. They made that quite clear. They said inflation concerns have not gone away. Then that would leave rates where they were pre the whole hiking saga. And that would give corporates a chance to roll over their debt, probably for another 5 years. I think that's what they're looking at. If they don't do that, then US corporates are in serious danger and the high yield market could just blow up. It could seriously blow up. And once that happens, then it just has a knock-on effect to all these different areas right across the board. Earnings. This is the other big factor. So what drove markets last year? Well, if you sort of break it down into the components of a bicycle, what you've got basically is, you've got the S&P. Within the S&P, the biggest driver has been the Nasdaq. Within the Nasdaq, it's the Nasdaq 100 that have really fired stocks everywhere. If you did not own the likes of Nvidia and Tesla and all of these other names, you lost out in returns. But they have largely justified their gains because of earnings growth. They've been growing earnings at roughly, give or take 20% year on year. The question is, can they sustain that? And what this is looking at, based on calls with companies and actual data released, are the revisions to earnings per shares over 3 months and year to date. This is all as of 2 to 3 days ago. So 3 months and year to date. And you can see there are some big slides here. I mean, just look at 2025 compared to 2024. The likes of, and if you look at what's being fed into this, it's the worries around tariffs. So worries around geopolitical risk, because that provides or leads to more supply constraints and supply disruptions. Just simple things like the Panama Canal crisis. Then you got the Straits of Hormuz. All these areas were impacted, even back in the days of COVID. So you factor all of this in, and companies are now becoming concerned. And then people are actually saying, well, can technology companies really go on pounding out these 20% annualized numbers? And then most recently, you've got the whole saga over DeepSeek, which has just shattered costs. The Chinese, on the back of existing chips, have found more efficient ways of delivering information and results, AI outcomes. If they now go on, as I'm absolutely convinced they will, to find and develop their own chips that can match the likes of Nvidia, then it's a game changer. You have to then seriously look at downwardly revising the Nvidia sales earnings forecasts. I think this is the next evolution. It's not a question of if, it's a question of when. And these times are just narrowing. The lead times are shrinking. However, it doesn't change the whole AI picture in terms of the implementation and what it can go on and do for you. It's going to lead to production efficiencies. It's going to lead to expanding markets because people will find bigger and better uses all the time. You pretty much got AI involved in anything that you do today to assist you in your endeavors to ask a query or carry out a task. So looking at this, I don't think these things are factoring in the potential forward outlook of what earnings can actually do. So the earnings picture is looking pretty stagnant, in some areas bleak. When you factor that in, that has an implication on growth. Here's one example, Walmart. This is a screenshot I took from somebody who follows it. The blended PE for this is nearly 40 times. But it operates on wafer-thin margins of around 3 to 4%. And it does beg the question, why did the Americans in the end only impose tariffs of 10% on China? You might recall during election campaigning, it was as high as 50 and 60%. And instead they settled for 10. Well, could it be that the likes of Walmart, an absolute bellwether in US portfolios, especially consumer staple type funds, which imports directly from China some 30 to 40% of all its goods. And then if you add into that the indirect, so this is coming through other countries, so from China to, let's say, Vietnam or to Malaysia, and then maybe another country, and then to the US, the actual figure is even higher than 30 to 40%. How do they absorb those tariffs on wafer-thin margins of 4%? They would have to pass that on to the consumer. They've got no choice. Otherwise, Walmart sinks. Its PE will crash. It hasn't even got much of a dividend yield. Look at its EPS yield. So this is, I think, it's pure speculation, but I think this is one of the reasons why in the end they came to a quick agreement with China. Remember, Trump's entire election premise was based on bringing prices down. Well, think how important Walmart is to shoppers in America. And if they're now passing on higher costs, that's pretty counterintuitive. So coming to the end of it, really, I mean, what are the forecasts for this year? I'm not going to go through all of these line by line, but I mean, here are some forecasts based on Goldman Sachs, who traditionally have been fairly accurate in terms of their predictions. And I'll just give some comments on some of these, but let's take bond yields because these are by far and away the most important. The US 10-year bond yield shot up yesterday on the back of the inflation data. So this is already out of date by just 24 hours. But their forecast for 12 months from now is that it's going to drop back to 437. And I think they're probably right on this, simply because it's the route to how you get to 437. It seems to be trading in a range of 4.5% and close to 5%. The high that I saw was around 4.8, and I think that's very doable. And at 4.8, imagine the discount factor applied to stock valuations. So they're saying that by the end of the year, it will come back to 437. So in that context, what are they saying about the S&P? Current level, not far off. That's quite close to where it is. They're saying there's room for some upside, 9% for the year from today's levels. That's largely their base case scenario. On bonds, you stand to make 6.3, but timing is everything. It's the entry point. On Japan, you'll lose because now the Japanese government really does, the talk is very much around rate hikes. Real wages are going up and more companies are applying them. If you look at some of these commodities, for instance, they're still bullish on gold. Now, in fact, day before yesterday, my colleague Theo was saying that there's some big adjustments going on in China around gold, and that gold has got legs for some time yet because it necessarily entails buying more gold. I think gold is definitely a good safe haven asset in this environment if you believe that inflation is going to be persistent, which I certainly do. You don't need hyperinflation. I'm not even envisioning hyperinflation, but just elevated inflation. Oil, they're saying, will linger at around 72. I think this is going to be an interesting one. I feel the days for oil are over, but yeah, we'll just have to see. I think there's so much production out there, combined with the transition to alternative energies, that I think it's over. And when you look at some of the geopolitical shocks that we've had, we've not had anything, and we don't seem to have anything on the horizon that's as big as Russia-Ukraine. Things in the Middle East have been largely neutralized. The whole Gaza side of life is very much about getting Arab countries to come to the table in terms of discussing the future of the Middle East. I do not think that Trump has any real intention of taking Gaza. God help us if he does. I mean, that's just, then you'll be hearing a very different projection from me. So overall, those are just some of the key areas. Therefore, looking ahead, this is very much in full flow. Decarbonization, that's now taken a knock because of Trump's arrival. I think that will just naturally follow its own course as people go more and more green. Debt remains an issue because that's directly impacted by yields, which I believe are, for the most part, going to go up. This will go up in full force. It's all about adoption. It's all about adoption. We've had the excitement rally. That was all last year. It's now about companies adopting AI and improving what they do to improve their margins and to increase their sales. And this is changing by the second. That is, when Trump talks about Greenland and Panama and now Gaza, this is what it's all about. He's shaping the corridor as he sees fit. And you either join that party or you don't. But he's really put other countries off balance. He's exploiting their weakness. China still has major economic issues. Its property market is not out of the mire yet. They've had several goes at trying to stimulate their economy, and it's had minimal impact. Minimal. For what it's worth, one of my favorite markets and regions is Europe, and within that, Germany. And I said this many times. Their election on the 23rd of this month is going to be a big, big decider. If the opinion polls are correct, as they've been consistently pointing out, we're going to see a return to a right-wing government, which will be the Christian Democrats in some sort of alliance with the far right, the AfD, the Alliance for Germany. And that's going to be very, very pro-market. And they're very keen. They've stated many times that they want to do a deal with Trump. That will open up corridors for Germany. So that's the end of it. I'll stop sharing there, and if anyone has any questions, happy to take them or try to.
Hello, Jabir. Thank you so much for that. I see there is one question from Lee Irvine under the Q&A section. Please comment on how you see the US dollar rate for the rest of the year, particularly relative to the South African rand. I don't know if you have any thoughts on that.
Yeah, it's so overall dollar will stay strong because the biggest driving factor will be better quality growth in America. It's as simple as that. You saw the projections there earlier in terms of the Atlanta Fed, If those figures, anything north of 3%, and that means the US is trouncing any other Western country. And remember, they do it on the back of massive consumer demand. That the consumer is what drives the US economy. 80% of its GDP is consumer driven. That's not the case in other countries. So I think overall you're going to see dollar strength. It'll be up and down. Whenever you have risk on, i.e. people wanting to take more risk, naturally the dollar sells off. It's nothing unusual or anything to worry about. That's what happens. People sell dollars to make other currencies available, like the rand, for instance. So coming on to the rand, I've always been quite bullish on South Africa as an economy. I think the election outcome and the new coalition between the DA and the ANC is a very positive move. And I'm not surprised that markets overall have done well, as indeed the rand has. I think a concern is this recent spat between the US, or I should really say Elon Musk, and South Africa and Ramaphosa, particularly over this new land law that he's come out with, the ability to expropriate land. It's, to me, it's just another bargaining ploy. But how I think it will play out is that if South Africa really wants continued aid from the US, it's going to have to negotiate. It's as simple as that. In the eyes of many, South Africa's been moving more and more towards Russia and China. And this even goes down to, various naval maneuvering in that part of the world. So I think it's going to lead to a better terms of arrangement deal between South Africa and the Western world. If it doesn't, it will be a knock. It will be a knock. But overall, if those growth rates are correct and America really continues to pile on, and Europe really wakes up and comes to the fore, it's going to be good news for commodities. And I'm not talking now oil. As I said, I think oil's had its day. I think it's the precious metals that will do very well. The likes of gold and platinum and all of that, palladium. And that's what South Africa has an abundance of. So it's a difficult one. I think we've got to get through this next patch, but perhaps some rand weakness in the short term, followed by rand picking up again thereafter. Those are my thoughts on SA.
Thank you so much, Jabir. So far, it doesn't look like there's any other questions. I think we can give it a little bit more time, maybe 10, 15 seconds, see if anyone has any queries. And if not, then maybe we can wrap it up.
Yeah.
Okay, yeah, I think that's great. Thank you. I'll let you wrap it up now.
Brilliant. Yeah. Thanks, everyone. Hope that was fruitful. And look, if you have any queries, then please, do email through Lee and Tamarin, and happy to take the questions. Thanks, everyone. Thank you. Goodbye.